The past year has come to a close, and if we looked at the stock market's 2024 Spotify Wrapped, it would probably read something like this. Investors fell in love with US stocks and the US dollar. A new US president and UK Prime Minister left investors with mixed emotions. Inflation slowed and interest rates began to fall, but not enough to get hearts racing or make mortgages and house prices cheaper. AI stole the show, and while it's not a competition, there is a leaderboard. The S&P 500 rose by about 25%, slightly beaten by the Nasdaq 100, growing almost 29%. With all of that behind us, let's turn the investing lens towards 2025. I'm George, Finder's investing expert, and if you're interested in some great sign-up offers for the UK's top investing apps, then take a look at the description below for the link. Okay, let's throw out a few fun predictions of mine, and then we can see how everything lands in a year's time. Keep in mind, this is not financial advice or guaranteed to happen in any sort of way. Just think of this as a fun bit of New Year speculation among friends. I'm not saying this is going to happen, because sadly, I'd be a very rich man if I could predict the future. And I'd love to know your predictions or thoughts in the comments down below. Right, so here are my predictions for the end of 2025. I'm feeling positive about markets overall in 2025, but I don't think we're going to see the same huge performances that some markets and stocks clocked in during 2024. I think 2025 will be slightly more subdued and sensible, but of course, we always have to factor in the unknown, and there's plenty of room for huge unexpected events to shake things up, for better or for worse. If you're completely new to investing, make sure to be realistic with your expectations and don't assume that the strong performances that we've seen in recent years will just keep rolling in without reason. The start of a new year is always a good time to take stock of your current portfolio, check in with things, or make a plan that you can stick to consistently throughout 2025. With Nvidia blasting off in 2024, solidifying itself as America's investing A-lister and becoming one of the most valuable companies in the world, if not the most valuable company, depending on which day you looked, we started seeing somewhat of an artificial intelligence arms race. This was good news for firms like Microsoft, who, in the hopes of future-proofing their position as a tech powerhouse, announced massive investments into AI. Specifically in private companies like OpenAI, the ChatGPT creator. However, some of the positive hype surrounding AI seemed to be more about its potential and not the immediate impact that AI was going to have. We also saw plenty of companies name dropping AI, either as a buzzword in earnings calls and investor communications, or linking it to new products, perhaps even slightly rebranding existing products with rudimentary AI features. Even though, at times, this felt like a cheap sleight of hand trick, it did lead to positive share price movements for most stocks that hopped on the AI bandwagon, so I can't blame them. For example, earlier in December, after the latest Salesforce earnings call, its stock price jumped about 10% due to lots of talk about its new AI system, Agentforce, which is at the heart of a groundbreaking transformation. However, the company didn't raise any of its financial forecasts or projections to show how this new tech is actually going to translate into more profit. For 2025, in the wise words of Eminem, I think we're going to snap back to reality. This tech will need to start actually having an impact, so I don't think it'll be good enough for companies to simply name drop AI in the hope that investors will just lap it up. With that said, I think there's going to be less AI-linked share price movement next year for US and global stocks. For example, with Nvidia, the price and size right now is already factoring in the presumption that AI is going to be the biggest thing since sliced bread, and Nvidia is going to be sweeping up every last crumb of AI business that's going, which isn't guaranteed if other chip makers step up or if Nvidia makes a single misstep. This makes it difficult for the share price to swell any further without putting a real strain on the market's ability to price in what would have to be future growth. Unfortunately, we're not back to the stage where inflation readings and central bank rate decisions aren't headline news. Overall, I think inflation will remain under control throughout 2025 by the methods that we use to measure it anyway, but that's a debate for another time. However, it appears like the US Federal Reserve is going to be pretty cautious about bringing down the Fed funds rate, and they don't want to do this too quickly. And it also seems like the market is still overly sensitive to comments from the Fed about the pace of bringing down rates. So we could see a decent amount of volatility anytime Jerome Powell and co grab the mic next year. These overreactions are usually just because the market was expecting to hear something else, and this mismatch between expectation and reality can present decent opportunities for investors. Higher rates all around can stifle growth and increase borrowing costs for businesses, which can be bad news for some stocks. Also, when savers and investors can get a decent low-risk return from high interest rates, they might be less likely to invest money into the stock market, and all of this could mean putting a bit of a downer on any market buzz. We saw a few companies start to test the waters with initial public offerings, or IPOs, last year, after a recent drought due to subpar market conditions. And at the end of 2021, some companies had valuations in the tens of billions, only to watch it plummet down over the following months, which explains why they're happy to be patient and wait out this storm. We did see Reddit go public successfully, with the stock price up by something like 270% since its IPO. Even in the UK, we had a relatively hot new IPO listing with Raspberry Pi, which is up by a respectable 23% or so. So this could set the scene for higher valuations and a flurry of IPOs in 2025. However, I do think it's likely that the UK stock market, the London Stock Exchange or LSE, could still get snubbed, with companies like Klarna choosing to list in the US instead. We might still see a Shein IPO here in the UK, but it's really only because other major markets like the US don't want it, reportedly due to the tense relationship with China, along with sustainability and labour concerns. As it makes up over 60% of the global stock market, the rest of the world is still going to be heavily influenced by whatever happens in the US. But here's what I think we're going to see elsewhere during 2025. Firstly, Europe seems to be in a pretty solid position. I'm not expecting a huge breakout, but finances across most of the EU seem to be in a pretty sturdy position. There's relative political stability in most of the continent, and on the whole, European stocks seem fairly priced with possible room to grow. Also, European businesses and factories could benefit from increased demand if countries like China get slapped with hefty tariffs from the US. However, whether Europe is ready to handle this level of increased demand is another question, and it could end up putting too much strain on Europe's supply chains, all of their businesses and energy supplies, which could just lead into higher cost and inflationary issues. For the UK, I'm not so positive. Although UK companies still appear to be cheaply priced in relation to other markets in Europe or the US, I think we're going to need a bit of a paradigm shift before we get the confidence and positivity needed to make UK shares a more attractive investment. I was hoping that the recent election and new government would act as a sort of a catalyst for this kind of movement, but it seems like we've already backpedaled into our age-old habit of general pessimism when it comes to UK investments. For emerging markets like China, Mexico, Brazil, India, Russia, and others, I think it's going to be a tough year. If the US dollar remains strong, this can create tough economic conditions in these countries with lower levels of investment if rates remain high in the US, as people are less likely to take on risk when they can get a solid return from sturdy and reliable US dollar-based investments like treasury bills. A strong US dollar can also make it a challenge for emerging markets to pay back existing debt. Also, on top of everything else, the Trump tariffs could also make economic life just more difficult in general in some emerging markets. Thanks for watching. Make sure you tune in next month, and if you want to check out our review of top trading apps, take a look in the description below or click here for our latest videos.